Hi, this is Nikki James, and today I'm going to talk to you about mortgage insurance, when we need it and what it is, and what the financial consequences of having mortgage insurance are. So mortgage insurance is required when you're putting less than 20% down on a loan. So if your down payment, let's say the house is 500,000 and your down payment is less than 100, that's less than 20%, we are going to require insurance as a lender to make sure that we will get paid back. So in the event of foreclosure, we want to make sure that we get our money back. And if your equity position is less than 20%, we consider it likely that we may not get our full loan amount back. And that's where mortgage insurance comes in. Now, of course, you pay for it, and we as a lender would benefit in the event that you went into foreclosure. It would help us make all of our money back. So not the greatest thing for us as borrowers to want to have to pay, but it allows us to put less than 20% down. There are a few things that happen when you're putting less than 20% down and you have mortgage insurance, in addition to just the upfront premium. So as you can see here, we say it's about 1.5%. That's probably on the high side. In many cases, it's more like 0.85. But this is a good rule of thumb. It does depend on your credit score and a few other things in the file. So that's how much you have to pay monthly. The other thing that we often forget is there's also a premium up front. So you actually have to pay 1 year premium up front, which again, in this case, could be the 500 a month, which would be $6,000 up front. So that's a little high in this instance, or in this example, but just know that there's a monthly premium and an annual premium. In the first year, you have to pay that annual. So the other thing to note is that when we have less than 20% down, we also require what we call impounds. It's also sometimes called escrows. And we also require reserves. So I'm going to go through all three of those. Well, impounds and escrows are the same thing. All that means is that we require you to put in escrow in a separate account. It's actually managed by the lender, and you pay it with your mortgage payment. We separate it out ourselves. We put into that account the amount to cover your mortgage insurance premium, the 1/12 of your annual property taxes, and 1/12 of your annual insurance. We put that into an account, and so that when the bill comes due for the mortgage insurance annually, for the insurance annually, your fire insurance annually, and for your property taxes whenever they come due, we want to make sure there's enough money in that account to pay it. So essentially, we're just not trusting you to pay your bills on yourself. We're going to pay them for you. So again, it's your mortgage insurance, property taxes, and insurance. Those things are what we call impounded, taken out of your and included in your monthly mortgage payment. They're put in a reserve account, or they're put in an escrow account. So all of those words mean the same thing. We just stick them in a separate account so that we have the money to pay the bill when it's due. Reserves, though, is an extra pad that we put into this escrow account, this impound account. In the event that there's a couple months where you don't make your mortgage payment, we still want to have enough money to pay the fire insurance. We do not want that to lapse. We need to pay the property taxes, and we want to make sure that that mortgage insurance keeps getting paid. So depending on the time of year and the time that you're closing escrow and the area when your property taxes are due, so that depends on where you're buying, we could require anywhere up to 8 months of reserves. That's the most strict reserves that we would require. Sometimes it's just 2 months, and it just depends on how many payments we're going to get before the bill comes due. That will determine how many months of reserves. So even though you're only putting, let's say, 10% down, it actually can be quite a lot of cash that you have to come up with at the close of escrow, because you're not only paying that annual premium for your mortgage insurance, but you've also got to fund the reserve account. So the 10% down goes up quite drastically. It often gets closer to the 20% that many times we figure out a different way to do it. So let's talk about a different way to do it. One really common way that we do to avoid the mortgage insurance is we do, you'll hear it, an 80-10-10. Piggyback, there's different words for it, but basically we take two loans. We do a first loan of 80% of the value of the house. Then we give you a small second loan of 10% of the value of the house, and then you put 10% down. Because the first loan is at an 80% loan to value, we don't require mortgage insurance. Now, the second loan is a variable rate. It's normally tied to prime. Tied to prime means that it moves with prime. As prime changes, then your interest rate would change. And it's normally an interest-only loan, at least for the first 10 years. So it's not the best, because you would prefer to have more of your entire loan fixed and not have to see that the payment could change. but it avoids mortgage insurance. So it's a bit of a trade-off. You don't get the fixed rate, but then you're not paying mortgage insurance. The other benefit of that second loan is you can pay it off anytime. So let's say you get some bonuses. You can always chunk away at that second loan and pay it off. Versus mortgage insurance, there's only two ways to pay it off. One is to refinance once you've got the 20% equity. The other way is to wait until you've got 25% equity and then actually challenge the bank to have that mortgage insurance removed. So the second loan gives us some flexibility there. It also allows us to get from into the jumbo market. Those are the larger loans or the higher priced homes with just 10% down. We often use this piggyback option to enable us to get into that market too. So a little bit confusing. Give us a call if your down payment is less than 20%. We'll, of course, walk through this with you, but hopefully that was a high-level explanation of mortgage insurance and impounds and or escrows, as we call them. All right, I hope to see you on another video. Again, Nikki James. Thanks for joining me.